Hello, I'm Mark, and you're listening to Resource Talks, the podcast for natural resource investors. I'm joined in this episode by Dominic Frisby, who is an exceptionally rare combination of financial writer and comedian. Although many listeners of this podcast will not be amused when they hear that Dominic is short silver and long the US dollar right now. We'll get into that later, as well as the contrarian indicator he uses to judge the mining cycle. Dominic is a financial pundit who writes for the British magazine Money Week. He also co-hosted a TV game show. He's written plays and hundreds of skits and songs, even breaking into the charts with a pro-Brexit anthem in 2020. Despite his versatility, however, Dominic is not your financial advisor, and neither am I. So take everything you hear with a pinch of salt and take care to do further research before making any decisions with your money. Dominic, thanks for coming on the show.
My pleasure. And you're absolutely right. Do further research before before investing your money. A very good disclaimer. And I should say, I am writing now a Substack. I have joined the Substack bandwagon, and my Substack is called The Flying Frisbee. You can find it at theflyingfrisbee.com. And it's sort of like, that's kind of my main gig now, that Substack thing. So if people want to follow me, theflyingfrisbee.com is the place to do that.
Excellent. Get the plugs in right at the very beginning. I like it. So
well, it was more because you had mentioned Money Week, and I was course, just sort of, yeah.
I'll get into the questions about the economy and commodities in a moment, but I think first I've got to acknowledge what an enigma you are. I don't think there's anyone else on the planet who has written a book on the history of taxation while also doing comedy on the side. So what came first for you? Was it the finance stuff or the comedy?
Well, actually, the thing that came first was voiceovers. I was, for some reason, I was the best at radio in my class at drama school. And as soon as I left, I got a voiceover agent and they got me voiceover works straight away. And that's an industry that's always been very good to me over the years. Although in the last 2 or 3 years, it's suddenly not been as good to me as it's been in the past, probably because I'm a bit old now and people want young voices, but also AI and home studios and all this. It's all just, you know, the changing nature of the media. And also there's less demand for old white men in the voiceover industry compared to what there once was. So that's how I started voiceovers. And I wrote a comic song, and from writing a comic song, I got into stand-up comedy. And then in the noughties, I was trying to raise the money to put on a project of my dad's, this thing called Kisses on a Postcard. And so there were all these clever people talking on the internet and about gold and things, and they all sounded terribly clever. And I wanted to find a way of meeting them without having to pay them for their time. So I started a podcast. And one of the people I interviewed was a lady called Merrin Somerset Webb. And she was like, oh, you must come. We need people like you at Money Week. And so that's how I ended up writing for Money Week. So it's totally accidental and unplanned, as all good economies should be.
Excellent. Talking of your column for Money Week, at the beginning of 2023, you made a call that this would be a bumper year for stocks despite macroeconomic headwinds. And that's looking like a good prediction so far, with the S&P 500 up 8% year to date and the FTSE 100 up 5%. Do you think this rally has further to go?
Well, the reason I made that call, and I make a lot of calls and I get some right and I get some wrong. And at the end of the day, you know, financial journalism is as much about entertaining people as it is about sound investment advice. That's not quite true. I mean, I do try and be right, but way more important than making big calls and predictions is managing risk, because it's how much you lose when you're wrong. That's way more important than how much you make when you're right. But, you know, there's obviously a lot of crossover between trading markets and financial journalism, but at the end of the day, they are slightly different. Well, there's also a lot of non-crossover. But anyway, the reason I made that prediction, I can't remember the exact number I predicted, but I predicted a bumper year for stocks, and I think I predicted it 15% on the S&P. I can't remember off the top of my head, but it was, it was a good year. And the reason for it was, firstly, coming off the back of a bad year. Secondly, third year in an election cycle, a US election cycle. It's if you look at the historical averages, third year in an election cycle is always the bumper year. You get the 4-year cycle low in the second year. Thirdly, there was this thing that one technical analysis calls the what did he call it? The Trivera or something like that. But there were 3 things that happened. One is that there was a Santa Claus rally. 2 is that there was a rally over that period over New Year. And 3, there was a positive January. And trifecta, that's it. And when you get all 3 of those things, it's like 95% of the time when there's been 3 of those things in the past, you've ended up with a bumper year. So all those things were what led me to make that prediction. And so far I've been right, but markets don't go up in a straight line, and we're coming into May, so we'll probably get a bit of a correction and yada, yada. But so far I've been right. And I think I don't see any reason why we shouldn't end the year higher than where we are now, particularly in the US. And stock markets and economies are not the same thing, as I'm sure you know.
So you put a lot of emphasis on technical analysis then?
I love it. Personally, it saves me having to think. It saves me, like, you can read about the state of the world and you can go, right, there's a war in Ukraine, there's inflation in the US, there's inflation in the UK that's higher than inflation in the US, there's unemployment at this, there's manufacturing at this, there's Chinese thing, the dollar's worth this. And you don't know how much weight to give each bit of news, each bit of fundamental analysis in your head. But it all gets digested in the price, and you can make it, and then you can also see the direction of the price. I'm a great believer in following trends, and the technical analysis is a great way of just weeding all that out and going straight to the point. Say, I can look at a chart. I could spend a whole day, you could spend a whole week reading, and then I could just look at a chart and probably arrive at a better decision on the basis of the chart than I would do with all the week's reading.
So you don't take it very seriously when people dismiss technical analysis as being like horoscopes for men?
I hadn't heard that one, but that's a good one. I get it. I'm a pretty kind of, some people are numbers people. Some people love data. Some people love a balance sheet. Other people, like going out and being an activist shareholder, and other people like going out and doing loads of research and discovering that, all the buildings that this company owns are empty, and therefore they're not going to get the rent, and therefore the price is going to fall, whatever it is. Everyone's got their own methods, and I'm not telling people that their methods are voodoo. and also, there's different sorts of technical analysis. I tend to just look at trends and I use moving averages, and I use RSI a little bit and MACD sometimes just to measure sentiment and whether something's overbought or oversold. So I keep my technical and I use trend lines. So I keep it pretty simple. I don't use Fibonacci, and sometimes I look at technical analysis on Twitter and stuff, and they're posting their charts. And I'm a pretty good reader of charts, but there's just so much confusion, so many different things on the chart that no wonder it gets confusing. But, you can't beat a simple moving average in my view, or actually even better, an exponential moving average.
The big financial story last year was the dollar strengthening as the Fed raised interest rates and investors look for shelter in the perceived safety of USD. And of course, so far in 2023, the dollar's taken a bit of a tumble, allowing equities, commodities, and emerging markets to rally. But you wrote that you think, like a horror movie monster that refuses to die, the dollar index might surge again. So could you explain why you think that and what the implications would be if you're right?
Well, just for clarity, because markets change, but I wrote that article on Wednesday, the 19th of April. So I'm not sure when this is going out. But so there's about three things going on that led me to make that call. Firstly, is I'm a big believer in the hype cycle and the narrative cycle. And the better articulated a story gets, funnily enough, the closer to the end of that story you are. And so now I remember, for example, in the late noughties, the US dollar is going to collapse, money printing. But there was this whole US dollar is going to collapse narrative was huge. And, gold was going up, oil was going up, commodities were going up. And the US dollar reached, I think it was 70 or 71 on the US dollar index. And then 2008 came along and it just rallied. And it's like the collapse narrative, it kind of ran out of steam. And, obviously last year, the dollar was 114, I think. And from 70 in 2008 to 114, I don't know what that is, but what is it? 60, 70, 80%, maybe not 80, but, 70% higher than it was in 2008 or even 2011. It retested those lows in 2011 at the peak of gold. But the whole US dollar is going to collapse narrative, apart from in like Bitcoin maximalist circles, that's kind of gone away. But it's been replaced by this new narrative, de-dollarization, which is kind of the same thing, to the extent that it means that people are no longer going to use the US dollar will no longer maintain its status as the reserve currency of the world. And like President Macron came back from China last weekend and he was talking about de-dollarization. Putin's obviously talking about it. Elon Musk was talking about it. What's his name? Tucker Carlson, the Fox News dude, he was talking about it. And these guys were never talking about the collapse of the dollar, but they're all talking about de-dollarization. And so it's really entered the mainstream. And meanwhile, we've got that St. Petersburg International Forum, like the Russian Davos, and they had a meeting, a summit in India, and they were all talking about de-dollarization there. And so meanwhile, gold is retesting its old highs just above 2,000, or it was a few days ago. And I almost think the narrative is just a little bit too evolved. And, you know what markets are like. They're like stand-up comedy. Just as you get too confident, they come and slap you in the face with a fish. And so I just wonder if that narrative is a little bit too evolved. And then I was looking at a chart of the US dollar index. And the US dollar index, it goes in one direction for for weeks and months. It's a bit like a large tanker or something. It takes a while to reverse, and you look at charts and it tends to trend in one direction for about 7 years, and then it takes about several years to make a low, and then it trends in another direction for several years. But even the counter trend rallies last many weeks and months. And I was looking at a chart of the US dollar index, and it's sitting on exactly support at 100, 101. And I just thought, there's a bit too much bullish sentiment about silver. And you know what silver's like. It's so volatile and it's a real love-hate thing. And, I thought silver was going to save the world in the late noughties. But I've since got a different perspective, is that silver is destined to disappoint. And you just look at silver and it looks a bit toppy at 26, and gold could be making a double top at its old highs. And this narrative is pretty of de-dollarization. Everyone's talking about it, and the US dollar meanwhile is sitting on support. And so I just made the argument that actually the least likely thing to happen here is for the US dollar to rally, and because it's the least likely thing to happen, it's the most probable, if you know what I mean. So I'm not betting the farm on it. I've not sold my gold. I've still got loads of gold stocks, but I'm just looking at it and going, And so I've taken a little short position in silver, and it just would not surprise. I'm also gone long the dollar against the yen. I'm not a massive spread better, but I play with it a little bit when I see signals. And my silver trade's flat so far. I was in the money yesterday, and then it's pulled back a little bit, and now I think I'm a couple of £100 down or something. But my short yen, long dollar trades looking good. So, only time will tell. I'm not going to go on political TV and have a massive argument about the dollar, but I'm quite humble. I make the argument. I've put my money where my mouth is, and if I'm wrong, well, I've got a stop loss, and I won't get hurt that badly.
Any reason why you're shorting it relative to the yen as opposed to against the euro or the pound?
Yeah, there was just I use exponential moving averages, 21 6-day moving averages, and I just got a cross, the moving average cross. It's a pretty simple trading system, and I've looked at so many different trading systems over the years, and for me it's the most reliable. So just a basic technical analysis symbol.
You wrote a column this month with the title, "The Gold Price Gets High, There's Still Time to Buy," which seems slightly at odds with what you're saying about the dollar possibly strengthening and your short position on silver. So is that not contradictory, to be bullish on gold but at the same time bearish on silver and bullish on the dollar?
Well, it's totally contradictory, but I wrote that article about 2 weeks ago, and I only wrote the dollar one yesterday, and markets change. And so, but I'm now going to make the argument for gold, which is that the gold price made its highest weekly close ever. I think it was last week or the week before, 2 weeks ago. And, new highs lead to new highs. The most likely thing when you break out to a new high is that you will break out to another new high. It's the least likely thing after you break out to a new high is that you then hit new lows. New highs normally lead to new highs. And it might be that this whole de-dollarization narrative has got a long way to go. It might be that China and Russia and whoever else are planning some kind of dollar-backed, gold-backed currency for the Shanghai Cooperation Organization, all the nations in Asia, with a couple of exceptions. All these, there are lots of reasons why gold would go higher. And I'm a gold bug, always have been. I love gold, and I think everyone should own. I'm currently writing a book about gold, actually, and I just think that everyone should own some in their portfolio. And I stand by a basic wisdom, which is an old Wall Street saying, apparently, although I've Googled it, and the only person that's actually said it on the internet is me. So maybe it's not an old Wall Street saying, but that saying is, put 5% of your net worth in gold and hope it doesn't go up. Because if it doesn't go up, everything else is usually doing well. And if it goes up, well, at least you're hedged. So it's a lovely saying, put 5% of your net worth in gold and hope it doesn't go up. And, gold's been pretty rotten since 2011. But if you're a sterling owner of gold, it's actually done very well. Like, did with all the weakness that came with Brexit, the sterling weakness and, incompetent government after incompetent government, and gold as your hedge against your government. And so gold, for sterling investors, gold's done pretty good. So I like it, and I think everyone should own some. And just because I've made a short-term call on the dollar, I'm talking about, a short-term thing that will be a matter of weeks and months, not a major high or a major low. And I do say that in the article. Long term, I think everyone should own some gold, and then they shouldn't sell it, and they should give it to their kids.
You pointed out in that article about gold that the junior miners of the metal are around 30% below where they were trading in 2020, even though the price of the physical metal today is close to an all-time high. So why do you think that could be? Why is there this sort of gap opening up between the performance of the physical metal on one hand and the performance of the junior gold miners on the other?
There's several reasons. Firstly, input costs are rising more than the gold price is rising. So even with a higher gold price, profitability is still not that good. The oil price and just general inflation, equipment, delays in delivery, all this stuff, it all costs. So that's a simple explanation. But if you go back and look at the Huey which is the index of unhedged gold stocks relative to gold, you will see that gold has been outperforming the Huey since 2006. I mean, there are periods, since 2004. There are periods of, counter-trend rallies where the Huey's done okay, but the Huey to gold ratio has been falling since 2004. And my explanation for that is that there are now so many ways to own gold. Like, one of the bonanza times for gold was in the 1930s in America. Home State was one of the winners of the 1930s. But the reason for that is that Americans had to hand in their gold. They weren't allowed to own gold. Roosevelt made it illegal for Americans to own gold, and they had to hand it all in and get dollars in exchange. So the closest thing they were legally allowed to own that wasn't gold was Home State, the US's leading gold miner. So that explains the performance of Home State in the 1930s. Similarly, gold only became legal for American citizens in, I think, 1975. So gold miners were the way to play the inflation. Invest in gold miners was sort of embedded in the US psyche in the 70s. But if you fast forward to the noughties, in the noughties, we had a million different ways to own gold bullion. You could buy coins or bullion. You could go to Gold Money or Bullion Vault or Gold Core or one of those online bullion dealers, the Pure Gold Company. You could own gold with one of those guys. You could buy the ETFs, GLD. I think GLD was invented in 2004, PHAU. There are hundreds of ETFs, gold ETFs. You could buy covered warrants. You could buy futures. You could spread bet. You could buy exchange traded notes as well as exchange traded funds. And then when crypto came along, there are now, I think there's like 100 or 200 different gold-backed cryptocurrencies you can buy. So there are just so many different ways that you can get exposure to the gold price and own physical gold. Why take on the individual company risk of owning a gold miner? And so that's my explanation, that the other means of owning gold have competed with gold miners for the speculative gold investment money, and they've won.
Interesting thesis. At the same time, you were expressing some doubt about the ability of gold's rally to sustain itself based on the fact that the junior miners are lagging. And you said that in a true rally for physical gold, you would expect to see the miners leading the way. So is that still your position as well?
Yeah, you want to see, like, if it's an out and out, I'm going to get myself a new Ferrari bull market, you want to see silver and the miners leading gold. That's what we got. I know gold has been outperforming the Huey since 2004, but in that bull market, 2000 to 2011, the miners led for the most part. And in that, there was a mega bull market. Was it end of 2015? There was like 6 months at the beginning of 2016 when gold was like a bonanza 6 months. Everything flew and the miners led. And even coming out of COVID in 2020, the miners led. But the miners are lagging so much now. It's just not a good sign. And I'm not turning mega bearish on gold. I keep saying it, everyone should own some, but if I'm making a short-term call, I'm a bit wary about this bull market because the miners are underperforming so much. It's just not a good sign.
Let's turn to Bitcoin, because I know you're very knowledgeable about that particular topic. And I understand that you see Bitcoin's rally in 2023 as being driven by the same factors that have pushed gold up, namely, and I'll quote you here, "With bank runs, bailouts, and another banking crisis now upon us, both gold and Bitcoin have suddenly fetched a bid. No surprise, they're both means to store value outside of the system," end quote. But the ARK Innovation ETF is also up 30% year to date. So do you think it could be that Bitcoin is actually much more closely related with profitless growth stocks than it is with gold? Because, after all, last year, Bitcoin behaved a lot like a Cathie Wood stock, getting absolutely crushed.
Yeah, you make a good point. My friend owns Facebook in her portfolio, and she bought Facebook very well towards the end of last year. And I think Meta, and it's been one of the star stocks. Meta has been one of the star. The Nasdaq's done really well this year. All those tech stocks that were beaten up last year kind of made sense. The more they're beaten up, the more they rebound. And yeah, Bitcoin's for several years now has behaved like a tech stock. And you could argue that the rebound in Bitcoin is because there's been a rebound in tech stocks. But when those bank runs started, bearer assets, i.e. assets outside the financial system, of which gold and Bitcoin are the most liquid and famous examples, they both fetched a bid. So you can look at the markets and you can impose your own narrative on what happened. You can go, it's because bearer assets, or you can go, it's because tech stocks. And probably it's a bit of both. And maybe it's neither as well. And there's some other reason that we don't know about. The reason, people like to attach reasons, and often stuff rises just because it's going up. I know it sounds a bit facile, but it's just the way stuff works. So, I accept your explanation. I also offer mine, and it's a bit of both, really. And so, but the fundamental truth that when those bank runs started, Bitcoin and gold both fetched a bid. And actually, the bank run panic seems to have passed. Maybe it was contained, as they say. And the rallies in gold and Bitcoin have they're flatlined, and you can either say they're making a top or they're consolidating. I don't know. But they're not roaring up like they were a month ago.
I'm going to get a little bit contentious here with you.
Sure.
Because you're on the record as saying Bitcoin is better money than fiat. But a study by moneysupermarket.com found that a single Bitcoin transaction uses an average of 1,173 kilowatt hours, enough to power the typical UK home for more than 3 months. So given just how energy consuming Bitcoin is, would it be materially feasible for it to be used as money?
That's not a that's one Bitcoin's worth of transactions, not a single Bitcoin, not a single transaction of a tiny amount of Bitcoin.
I suppose that I'm not sure, to be honest. Actually, is the answer. They didn't specify
if I
that
send
it was
someone
one Bitcoin's worth.
I think so. I mean, I'd like to check that, and obviously we can't in the context of this podcast. But that fact of, like, if I transfer whatever it is, 1/100th of a Bitcoin on the Lightning Network, I don't believe it consumes anything like the amount of energy that you've just described. And if it does, it's a good thing, because the more energy that Bitcoin consumes, the stronger the network, the more robust the network, and the sounder the money. People don't understand that the whole point of Bitcoin is that it consumes a lot of energy. There's this crazy narrative that by consuming a lot of energy, something is bad. That's not true. And if you want to argue about the energy waste of fiat money, well, look at what it gets used on. Look at what it gets spent on. Look at the American military, wars, government waste, the NHS, how much money gets wasted in the NHS, printed money gets wasted in the NHS. You cannot compare the waste of Bitcoin, the waste of fiat money, to the energy use of Bitcoin. And moreover, the energy that the Bitcoin network consumes is energy that would otherwise go unconsumed. This is what people don't understand. This is why. So Bitcoin mining because Bitcoin mining is basically as profitable. The more the cheaper the energy you use, the more profitable Bitcoin mining is. And therefore, Bitcoin mining inevitably gravitates to where energy is cheap. And the cheapest energy in the world is energy that goes unused. So, for example, you'll see lots of Bitcoin miners next to nuclear reactors, because the energy there is very cheap. Or you'll see lots of Bitcoin miners in geothermal places where that energy, or hydroelectric dams. And it will often gravitate with the weather. You see the flaring of gas in the US is a major problem. The gas they produce when they're mining for oil, it's cheaper to just flare it. I mean, it's so wasteful and so damaging. The Bitcoin network uses that energy, and the result of that energy consumption is the most robust, unhackable money system the world has ever seen. So how can you accuse it of being a waste of energy?
I heard a podcast about exactly that, about how there was a big Bitcoin mining industry that grew up in Venezuela, because at some point before the collapse of their system economically, they were subsidizing energy to such an extent that the miners could make massive profits doing it there, because they were paying basically nothing for their electricity. And the Venezuelans caught onto it, and they started sending secret agents to try and knock down the doors of these Bitcoin miners and drag them out of their homes. It's a very interesting story.
Yeah, well, it is interesting. And that Bitcoin mining will have used fossil fuel, which is not good for the environment. I think something like 60 or 70% of Bitcoin mining energy, maybe it's higher now, is renewables. And when it's using fossil fuel, it's not as good for the environment. But the reason the Bitcoin mining gravitated to Venezuela, where energy was cheap, it's not the fault of Bitcoin, it's the fault of the Venezuelan government for its interventions in the energy markets. And in fact, I understand that the Venezuelan government itself was mining Bitcoins. And then you look at what the Venezuelan government has done to Venezuelan currency and how many lives it's destroyed there. And I remember in the early 90s, Venezuela was the richest country in South America. Now it's the poorest, and it's untold misery has been caused by the hyperinflation there. And for the few people that have been able to get access to the sound money that is Bitcoin, it's been a total lifesaver. So there.
But is anybody in Venezuela actually using Bitcoin to go and buy their groceries?
Yes.
Yeah.
Oh, maybe not to buy their groceries, but people in Venezuela are definitely using it. What you need to understand about Bitcoin is not so much a currency for the physical world; it's a currency for the digital world. But they'll use it to send money to each other and to store value. I'll say. I mean, that the pound is so rubbish. The UK stores its wealth in housing. Everyone who buys a house thinks their house has gone up in value. It hasn't. It's just kept its value. It's money that's lost its value. And it'd be wonderful if you look at the 19th century. The value of money actually went up over the course of the 19th century. So the purchasing power of a salary increased, even if the salary stayed the same. And that's what should happen with money. Its purchasing power should last, and fiat money doesn't do that, and Bitcoin does, and gold does.
Well, now I've gotten you fired up. Let's move on and talk about mining companies, which you said is quite a boring topic. And you made the point in an article last month that in comparison with tech, investors really find mining to be very, very sleep-inducing indeed. You wrote, mining is slow. The basic principles extract metal from rock are not far off from what they were in the Bronze Age, end quote. And by comparison, tech companies, app developers, for example, they can go from one person with a laptop to millions of people connected using the end product in days. So in your view, what will it take for retail and institutional investors to get interested in the natural resources space?
I don't know. I stand by that point, and I mean, I'm hoping you would agree with it. And mining just takes so long, and it's not just the permitting and the regulation and the this and the that, which the getting the whole thing through government. It takes, even without all of that, to find a mine, to explore it, to develop it, to build the mine and get through to the point where you're actually producing metal, it takes years and years, more decades sometimes. And why would somebody invest when they're not going to see any return on their money for 10 years or more? The only return you're going to see on your money is on the assumption that the value of the mine increases and somebody else is prepared to pay more for it than you did. So it's kind of like speculating on a physical asset. So it's just so slow and so long, but it is essential because nothing in the world would exist without mining. That's why it's the oldest industry in the world. It's probably even older than the oldest profession in the world, I imagine. It's competing. But we need stuff and we need mining, and it's a difficult industry. It's not glamorous, and the returns in tech are so quick. You can build an app, upload it to the App Store, and suddenly you're a millionaire if it catches on. Or you can design some stupid JPEG and make it into an NFT, and Lord knows what those children do, but they do it and they end up with way more money than I'll ever have, and it is a mystery. But anyway, that's what goes on. And investment and talent and all the rest of it will inevitably gravitate to wherever the returns are biggest and quickest. And that is tech. It has a scalability that the boring old physical economy doesn't have. And the most physical of the thing in the physical economy is mining, the most physical industry. And so, it's just slow, and it's also, in the eyes of many, the most evil industry in the world. And it's, mining has a lot to answer for because of the damage it's done over the years to the environment. But it is also essential. And you can't do without it. I know we have no mining left in the UK, hardly. We used to be one of the mining capitals of the world, and we used to send our mining engineers all over the world to work the world's mines, all over South America, North America, Africa, but Asia. But that's no longer the way. And it's a shame because I feel we've lost touch with something. But what will it take to get people interested in mining again? Much higher metals prices and a massive bull market. But the problem is, when that happens, all the scoundrels will appear and they'll start promising you this amazing deposit when really it's just moose pasture. And so loads of people will end up losing loads of money, and the industry will go back into recession again, and half the participants will swear never to invest in another mining company again. That unfortunately is the way it works.
You cited a Mark Twain quote, I believe, didn't you, about a mine being a hole with a liar stood next to it?
Yeah, a hole in the ground with a liar standing next to it. I think it's attributed, but anyway, it's he lost a lot of money, Mark Twain, speculating in mining stocks.
Did he? I didn't know that.
Yeah.
Where do you think we are
just stuck to the writing?
Yeah. Where do you think we are in the cycle currently then? Because, of course, mining's a cyclical industry. And I understand that you have a contrarian indicator that you were writing about just a few weeks ago that you said helps you judge it.
I can't remember what the contrarian indicator is. You'll have to remind me.
It was the headline of your piece only a few weeks ago. I believe you went to a mining conference.
Oh, yeah. I went to a mining conference and it was dead. There was literally just like a couple of granddads there and a couple of old geologists, and that was it. And we were just so dead. And that normally when a conference is that dead, it means that it's the bottom. But I'm interested to know what you think about where we are in the commodity cycle, because everything I read points to higher commodities demand, especially net zero and electric vehicles and all that. An electric vehicle needs 4 times more metal than a normal combustion car. And if we're to realize net zero, then we're going to have to mine more metal than we've ever mined in the entire human history. All that stuff, the expansion of the middle class in Asia, copper demand's going to go through the roof, tin demand. You look at tin supply, it's totally dependent on Indonesia and Myanmar, which it could fall apart at any moment. Tin's going to go to the moon. We're going back to gold standard, de-dollarization. Gold's going to go to the moon. Silver's in every single appliance you can possibly think of. There's a silver shortage. It's shorted on the COMEX. Silver's going to go to the moon. You can find these arguments for every metal there is. And yet, for the most part, metals prices are pretty flat. Now, with all these arguments and all these stories doing the rounds, if they were actually true, surely the price would be behaving better. And it isn't. So that worries me. And that makes me think we're in one of those sort of nothing cycles, neither bull nor bear. I don't think we're in an out-and-out bear market because we've already had that. But maybe, a lot of people say we're in 2001 or 2003, but maybe we're in like 95 or something and we still got just a bit more mud to wade through. But I mean, I'm interested to know what you think. Where do you think we are in the commodity cycle?
You're trying to inverse the interview right now. Well, and I'll just say rather evasively that if you had a look at my stocks and shares portfolio, you might find yourself a lot less interested to know what I think. Because, clearly last year I thought uranium stocks were going to be taking off very shortly, and that was a totally wrong call. So yeah, it's that's why I get the guests on, because I certainly don't have the answers.
You talk to a lot of people. You're an investor. You've got to have an opinion. I'll tell you about uranium in exchange for your opinion on where we are in the commodity cycle. I will tell you about uranium and how to not lose money in uranium.
It all depends on whether or not we go into some horrible global recession or not, really, doesn't it? Because that will take down equities and it will take down the commodities with it too. But maybe if there is a bit more optimism later this year or next year about global economic growth, then maybe things could turn around very quickly. But it seems right now everybody's bracing themselves for a crash, aren't they?
Yeah, you haven't really answered the question. I feel like I'm talking to a politician.
Oh, well,
Where are we in the commodity cycle? You're not. If you're not sure, say, because I'm not.
No, I'm certainly not sure at all. No, absolutely not. I'm a blind man grasping forwards with absolutely no idea what's in front of him.
I know the feeling, and as long as you recognise your blindness, that'll probably lead you to make a lot of money.
Not sure how you arrived at that conclusion.
Because there's no hubris. There's no I know better than the markets,
Right, yeah, of course. So you were going to tell us something about uranium stocks before you have to run off.
I like uranium. I think it's a massive problem solver. I can't believe we haven't embraced it sooner. I noticed that it's been rebranded in the UK as a clean energy. You obviously know about that. I know that when you have a uranium disaster, it's pretty horrific. And we have this sort of innate fear of nuclear power, but it is a massive problem solver, and it's clean. And I think way less lives have been lost to uranium than have been lost to coal and oil and gas. And in particular, I think a massive problem solver are these small modular reactors. The tech's already there. We've had nuclear submarines going around our waters for however many decades. As far as we know, there's not that much damage. You can put one small modular reactor that takes up, you can put it underground in a field. It's not that big, and you can it can supply the whole county with energy. And it can be erected pretty quickly and doesn't have to go through all the government regulatory stuff that, Hinkley Point or somewhere has had to go through. I just think uranium is a massive problem solver. And there's a shortage of uranium supply. But it's one of those ones, you look at it and you go, well, there's Kazakh uranium supply, and there's a little bit in Canada. And then there's old Russian stockpiles, but they seem to be mostly depleted now. And, I think looking at yellow cake was about £2 in 2020, and now it's maybe £3.50, something like that. So the uranium price is up. It's not quite double, but it's up 75% or something. The problem with almost every uranium miner, Cameco aside, and you buy Cameco and you're taking on operational risk, and you're taking on the risk of that management and the dodgy share price structure and all that kind of thing. But most other uranium companies will not mine, even the good one, even the ones that have got the sexy deposits, Fission Uranium and Paladin and whoever it is. Maybe Paladin's not a good example, but most of those companies will not see any production. Laramide or someone, they won't see any production for 10, 15, 20 years. You just won't see production. So inevitably, all you're going to see is dilution. So you can argue that as the uranium price goes up, then the value of those deposits in the ground will go up. But, and they're a year or two closer to production. But the reality is, that is more than offset by the dilution, because mining companies that don't make money have to dilute. They have to raise capital. And, maybe the board will time it well and they'll do their capital raises at good times when the market's strong and blah, blah, blah. But because those companies are never actually going to make any money for at least a decade, that just makes them rotten investments. So you've either got to go, I'm looking for a total explorer, grassroots explorer, and all I want this company to be is an office and a geologist and a CEO. That's all I want, nothing else. And you go total grassroots, market cap of a couple of million or something. But those development plays, and in the 10-year time or the 20-year time before you see production, there's just so much that can go wrong. The attitudes to uranium can change. There could be another nuclear disaster. The locals could oppose, you might get a green, really green local government in place that opposes all development. The capital markets could implode. There's just so many things that can go wrong. So I don't like uranium miners for that reason, because unless they're actually producing and making money, or they're a total grassroots explorer and they make a discovery, but that's just a, crapshoot. It's just, that's the problem with uranium miners. So how to invest in uranium is just really difficult. And a lot of the time I just look at it and I go either Yellow Cake or Rolls-Royce, because Rolls-Royce is going to get the gig doing all the small modular reactors, because they're not going to give the gig to an overseas company because of the security risk, particularly now, and particularly not a Chinese one. And so Rolls-Royce has got the technology. Rolls-Royce is going to get the gig, or has already got the gig. So, but then Rolls-Royce has got all its other problems. It's not a pure play. So that's where I stand on all of that. And I can be bullish about uranium, but it's really hard to find a vehicle by which to invest in the sector beyond owning the metal itself.
And do you own the metal itself, or have you been put off from buying that?
No, I don't. And I should have done, and I mean to, and I should just have 2, 3, 5% of my portfolio in Yellow Cake or Uranium Participation Corps or whoever it is, because it's fairly obvious to me that in 2 or 3 or 5 years' time, the value of Yellow Cake's holdings will be greater than it is now because of increased demand. But then what might happen is there's suddenly a uranium shortage and the government needs uranium for the emergency because the Russians have blown up all the wind farms or whatever it is. And then they just confiscate the uranium. That's not beyond...
I think the uranium that Yellow Cake owns is stored in Canada, isn't it? Yeah.
Well, it's even more likely to happen there.
Well, yeah, absolutely. Dominic, I know that you have to run now, so thanks for taking the time. It's been a fascinating conversation. Listeners can subscribe to your newsletter over at dominicfrisby.com. Is there anywhere else they can go?
Flyingfrisby.com.
Oh, okay. Flyingfrisby.com. Is there anywhere else that they can go to keep up with you?
Yeah, but the flyingfrisby.com is the place. That's where it all starts there. And I write about the kind of stuff I think your listeners are interested in, and there's an obvious marriage to be had here. And if you like my unacceptable views, then go to the flyingfrisbee.com and find out more there.
Thank you so much.